In this week's Property Insider video, Dr. Andrew Wilson and I peel away the layers from the latest Australian Bureau of Statistics employment figures and show that things aren't really as good as some people would suggest. Of course, there's lots of good news, and we discuss some of the interesting new statistics Dr. Wilson's come up with for what's happening in our housing markets. And we're going to talk a bit about some interesting comments that came out from the Reserve Bank over the last couple of weeks, which are going to give us some direction of what's ahead. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so we can update you every time a new show comes out. Despite all the bad news in the media, there's also been lots of positive news over the last few weeks. While the easing of the COVID-related restrictions won't come quickly enough for many of us living in Victoria and New South Wales, at least now there's a roadmap that aims to balance the health challenges and the social and economic challenges brought about by the lockdown. Then, of course, we dodged a recession last quarter, and now the official ABS figures show that unemployment fell to 4.5% in August, down from 4.6% in July. This is, of course, down from that 22-year peak of 7.4% just over a year ago in June 2020, and it reflects a continual improvement since Australia's unemployment rates now return to pre-pandemic levels. At the same time, our property markets keep performing strongly, and it seems that Australia's fast approaching its first target, 70% of those aged 16 and above having a single COVID vaccine. Overall, we're doing much better than those property pessimists and the negative Nellies predicted not that long ago. And today, Dr. Andrew Wilson is going to share some updated property statistics that show where our property markets are going to be heading. But if you dig deeper in below the surface of some of those Australian Bureau of Statistics figures, there are some causes for concern. And that's what I want to discuss today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of My Housing Market. Hello, Andrew.
Good morning, Michael. We're well and truly into the spring selling season now. In fact, we're heading towards the end of the first month of the spring selling season, and it's certainly been a very positive opening to the season, and notwithstanding, of course, that we do have those constraints from COVID restrictions.
That is interesting, considering how we are hamstrung, how well the markets have done. And I want to talk about that in a moment. But I'd like to start off maybe talking a bit about unemployment, because officially Australia's unemployment rate's the lowest level in almost 13 years, despite half the country being in lockdown. However, those figures don't really seem to reflect what's happening on the ground, where things have been getting worse for Australian workers. The headline unemployment rate sounds good. It's been falling in August, but as the lockdowns were implemented, more Australians they're working fewer hours or no hours, or underemployment's risen. What's your take on what's happening as businesses are closing their doors and not being able to employ people?
These are the intricacies, Michael, of the unemployment rate model. What we've seen, even though the headline rate has fallen, it's fallen particularly as a product of fewer people in the workforce, notably, of course, in New South Wales, which is in lockdown. So the actual participation rate, which measures the proportion of the population that's either in work or looking for work, has fallen quite sharply. And of course, that's no surprise. We saw the same thing occur last year. So what it means is the pie has actually shrunk. And it's not just those that, and that includes, of course, the number of unemployed. So the number of employed fell, and the number of unemployed fell as well. But that was because those that were unemployed actually left the workforce, because one of the factors that has allowed that to occur or motivates the unemployed to leave the workforce is that their mutual obligations that they have to qualify for their JobKeeper allowance is put on hold during the lockdown period. They don't have to be registered as unemployed to still be a beneficiary. And that means that the number of unemployed fell, the number of employed fell, so that the pie fell from our workforce, from what we measure the number of unemployed from, and that meant that the unemployment rate fell. And also the number of hours worked was also sharply lower, and that's no surprise. So really the national rate was primarily affected by a sharp decline in the participation rate in New South Wales. And of course, this is not to be surprised, and we will see a similar outcome from Victoria when we get the next lot of data. Of course, Victoria has increased the severity of its lockdown since those last data was released, which of course was the August. It's a great result, 4.5%, but when we look a little closer, Michael, our workforce has shrunk considerably from those that have been discouraged from finding a job or looking for a job, and that's made the unemployment rate look pretty good, but it's not a positive result.
Interestingly, over the last week, a number of the regular property pessimists, so they're doing the rounds of the media again, Andrew. They're chasing headlines. They're telling anyone who's prepared to listen that many Australians are going to fall into mortgage stress when interest rates rise. And they're saying that this is going to occur sooner rather than later. However, once again, Governor Lowe just came out and said that's just not going to happen. He seems to find it difficult to understand why the market is pricing in rate rises in 2022, 2023. And he again reiterated that it's not going to be when inflation hits the target of 2.5 to 3%. It's got to stay there for some time. And I think the other interesting thing he again reiterated was that rising house prices aren't really of a concern to the RBA at the moment.
Well, why would they be? I mean, it's not in their remit anyway, the housing market, and they've had their fingers burnt by getting involved with APRA and Treasury with those notorious macro-prudential policies of 5 years ago that really did and continue to create significant disturbances in our housing markets and our economy. So they've washed their hands of the mess that to some degree that was created through those really misinformed policy positions. Michael, the debt bomb's been waiting to blow up for 4 or 5 years now. It's the headline that keeps on giving. Perhaps we need the media just to have a little bit of a clearer think about what they're actually printing, because this stuff is cloud cuckoo land stuff. And it keeps coming back. It had been a little quiet for a while, but I noticed that the debt bomb proponents are now attaching themselves to mortgage facilitators in the hope that people will buy this nonsense and change their mortgages, lock in fixed term mortgages, because they're feared of higher interest rates. And as you said, the Reserve Bank governor has come out yet again to say that this is just not going to happen. And people tend to buy these headlines without a lot of thought. But look, read my lips, interest rates aren't going to rise anytime soon. We're talking years, not months. The Reserve Bank has said 2024. It's not just about inflation. And again, I'm perplexed by the number of economists who don't understand monetary policy and how it works, that keep focusing solely on inflation. We're likely to get higher inflation over the foreseeable future for a number of reasons. We are coming from a low inflation adjustment period, although that will be again ameliorated by current lockdowns. But we've also got some building inflation, particularly in construction costs, which will work into that headline rate. But the point is, it's only half the story, Michael. If we don't, we can have inflation till the cows come home, and it won't mean higher interest rates unless we're getting a corresponding increase in incomes, which we haven't had for over a decade. In fact, no advanced economy has had higher incomes generated through lower interest rates since the GFC. So what's going to change now? Well, nothing's going to change now. We may have some relief because of lack of competition from migration, but that's not evident now. We've had a year now of virtually no international migration, and we still haven't had a tick up in incomes growth. We need to have incomes growth and inflation to even think about raising interest rates. And as you said, Michael, we wouldn't have it just for one quarter. We need to have a consistent period of strengthening inflation and higher incomes for the Reserve Bank to even think of raising interest rates. Because the real conundrum, and again, please, economists, go back to your micro and macro textbooks and have another quick read of them, just to inform yourself of the relationship between incomes and inflation and monetary policy, because the nightmare for the Reserve Bank would be if we had higher inflation and flat incomes, because that would mean, of course, that real incomes were falling. And that would be obviously a hit to the economy, to consumerism, to business confidence right across the board. So the Reserve Bank would, the last environment that they'd be considering raising interest rates was if we had flat incomes, higher inflation, because that would certainly have a clear impact on the economy. So we just keep saying the same old things here, Michael, don't we? Yeah. It used to be year after year. And I guess it's one thing for the the headline chasers in the media to keep speculating on higher interest rates sooner rather than later. We've just got to keep our fingers crossed that the Reserve Bank don't buy into this nonsense.
I hope they don't. But there was another interesting comment from the Reserve Bank over the last couple of weeks. Reserve Bank Governor Lucy Ellis lashed out at the federal government. She suggested it was actually negative gearing and capital gains tax discounts encouraging speculative investments that are fueling our current property prices. Andrew, I found that really interesting comment at this time when the number of investors is well below historic averages. And in fact, the government has been going out of its way to support first home buyers. And this market so far, this boom that she's talking about, has really been led by owner-occupiers.
Absolutely, Mike. I think the Reserve Bank would be well advised to stay out of housing market analytics. They've had their fingers burnt consistently. Lucy Ellis, I remember not that long ago, predicted that we'd seen the end of double-figure prices growth in Australian capital cities. Well, gee, that one's hasn't really exactly turned out as Lucy predicted. And I think you're absolutely right, of course. We've had the lowest level of investor activity in this recent market that we've had in history. It has started to rise, but investor market share is around about 25% of total residential lending at the moment. It is rising, but the long-term averages are around 34%. So even though investor activity is increasing, it's increasing from a very low base and still well below long-term average levels. And if we are starting to see the end of the strong price growth cycle, we are only talking about a quarter of the market, Michael, that investors are participating in at the moment. So I don't think it's going to be enough on its own, that proportion, to continue to fuel the level of prices growth that we have at the moment. And of course, if negative gearing and tax depreciation and capital gains discount was such a nirvana for investors, why haven't they been around for the last 3 years? They've disappeared despite all those wonderful benefits that the Reserve Bank seems to think will fuels outrageous property speculation. It just doesn't add up on the data. In fact, the consequences of decline in investor numbers, the record decline in investor numbers, which was a direct result of those APRA actions that created an investor credit squeeze, what we've seen is those consequences, which I clearly predicted at the time, particularly on the supply side. Despite home builder, which has created a boom in houses over the last 12 months, we're still 16% on an annualised basis below the peak new dwelling approval levels of way back in 2016. So we're still undersupplying our market in terms of new property. And of course, if we hadn't have had the curtailment of or the closing of borders, we really would be starting to see issues of housing shortages. But we are starting to see housing shortages in the rental market, Michael, because that constraining effect of the APRA credit squeeze on investors and the obvious collapse in investor numbers has created a chronic shortage of rental properties in our capital city markets, particularly houses. And we're now seeing rents going through the roof in a number of capital city markets. In fact, all capital city markets, the house rents are rising quite sharply, except for Melbourne. And Melbourne, of course, has some issues in migration, but Melbourne's still a market where it's still much in favour of landlords. Vacancy rates are all quite low for houses in our capital city markets, Michael, and we'll continue to see that. And despite the marginal increase in investor activity as a reflection of market share, it's not going to fix the undersupply of rental properties, and that is a real cause for hardship. And it's just on two sides of the coin there. We've created an undersupply of new dwellings and an undersupply of rental properties, all as a consequence of those experimental macroprudential policies that were introduced in 2016 and then revisited again in 2018. And these issues are going to take a long time to fix, particularly once we get borders opening up again, Michael.
Sure, you can see how the shortage of properties is going to keep pushing up property values. In the meantime, there's also been a shortage of properties for sale for obvious reasons. Who'd put their house on the market when you couldn't get people to come and inspect? And since most sellers are also buyers, when you weren't sure that you could buy another property. But I think there's been a change in sentiment from vendors recently, and they're now coming back to the markets, Andrew.
Yeah, I think we're seeing the consequences of the recent positivity in regard to the outlook for COVID restrictions, Michael. We do have now a pathway to, I guess, Freedom Day in Melbourne and Sydney. People are a lot more positive about the outlook. The Victorian Premier has announced that he will be easing the restrictions on property inspections, still pretty tight, but nonetheless, people can now inspect properties. Auctions are still banned, open air auctions. But I think what we've seen as a result of that over the last week is a surge in new listings nationally. And I think that's part of the spring vibe, but very much so part of the positive outlook for sellers that there will now be more of a normalised environment for property inspections, not just in Sydney, but also in Melbourne. And this is resulting in a very big increase in new listings over the last week. And new listings are now tracking considerably higher than where they were at the same time last year. And we must remember that at the same time last year, Melbourne was in the depths of lockdown. So there's no surprise that new listings are higher than a year ago. But it's a real, I guess, spring in the market, Michael. New listings coming in. It's what we expect this time of the year, but I think it's just a stronger rebound because of the lockdown that we've had in August and moving into September, but driven, of course, by some more positive news in terms of the functioning of the property market.
That's a good sign. It'll be interesting to see what the depth of the market is and how those properties are now going to be taken up by the buyers there. But yes, again, remembering that many of these sellers are going to be buyers also. They're in the market, so the depth of buyers seems to be there, particularly at the auction markets, Andrew.
Yeah, look, good point, Michael. And the auction markets are reflecting that rise in new listings. Another very strong weekend, in fact, a strengthening weekend for our auction markets. Sydney, again, with a clearance rate in the mid-80s. That's 3 weekends in a row in the mid-80s for Sydney. And Sydney's now recorded clearance rates above 80% for most of the past 2 months. So we also saw an increase in auction numbers in Sydney as well. So I think we've sort of moved past the adjustment phase through lockdown, and we're now seeing auctions coming into the market that weren't booked in prior to lockdown. So this is more of a normalised market. And these numbers, they're probably around about half of what they would be without the restrictions, because we had very strong numbers prior to the August lockdown, the July-August lockdown. We had record numbers of auctions, well over 1,000 every weekend in Sydney. We're now tracking over 500. As you said, Michael, is that despite, those lower listings are actually driving higher clearance rates, because there's plenty of buyers out there and they're fighting over whatever's available, and they're very strong clearance rates. We also saw the other capital city markets have strong clearance rates, Michael, higher listings, strong clearance rates in Brisbane, Adelaide and Canberra. The Melbourne market was above 70%. Again, it was lower than the previous weekend, but again, when we look at some of the details, we can see that the withdrawal rate actually doubled in Melbourne last weekend. So the rate of sales per listing was actually the same. It was just that we had more withdrawals. And of course, withdrawals are counted as part of the auction process. So they're more or less counted as a passed in. So it was that double level of withdrawals that pushed the clearance rate down in Melbourne. But yes, numbers are low in Melbourne, but given that they were basically zero a year ago, it shows how the Melbourne market has changed in 12 months, even in the depths of lockdown. Is a significantly higher number of transactions that are occurring, and that, of course, is in the online environment. But it also shows that people are really just waiting for the gates to be lowered, Michael, and the market will be up and running in Melbourne. And we've certainly seen early signs of that now with that surge in new listings. And obviously, it's a little bit of a retarded, spring selling season, but not too much. And it's certainly looking like it's ready to roar back again in terms of the overall number of properties in the marketplace, because that new listings data I thought was particularly instructive.
Well, putting all that together, it looks like the year is going to finish up on an even higher note than anyone would have expected at the beginning of the year. So we'll be back each week to give our thoughts and commentary on the market. Thanks for your time, Andrew.
Yeah, thanks very much, Michael.